This is Window on the East, a podcast from BNE IntelliNews. Subscribe at bne.eu.
Again to a BNE IntelliNews podcast with me, Ben Aris. I'm the editor-in-chief. And today I'm joined by Liam Peach, who's a senior emerging markets economist at Capital Economics, and Tomas Dvorak, who is an economist with Oxford Economics. And we're here to talk about the coming crisis as is, but from the perspective of looking at the other side of the coin, not what's going on in Russia per se, but the crisis, the economic crisis, energy crisis, cost of living crisis that this whole war has caused, and to try and get a head around, for me anyway, just how bad it's going to get. Because I think there's been a lot of discussion about what's going on in the Russian economy and how it's surviving sanctions, doing better than expected. But the blowback on our side is significant, and it's now increasingly causing problems for everybody. As these tenfold increases in energy prices, for example, start to kick in. Here in Berlin, we're just waiting for our end of quarter power bill, and it's going to be very unpleasant, I'm told. So, guys, maybe we can dive straight in. Adam Tooze, US professor, he's actually quite succinctly dubbed this as a polycrisis, that it keeps proliferating. I mean, there's been talk in the British press a lot about the cost of living crisis that's related to the inflation, which actually started before the war did and was driven by the pandemic. But then now we've got connected to the gas supplies, the problem with an energy crisis. And that, we just did a piece in BNE, is already affecting industry in Europe, both Central Europe and Western Europe, with the energy intensive industries either cutting back production or even closing down. And I just did a story this morning where S&P were predicting the car production in Europe could fall by as much as 40%. And beyond all of this, I have the very strong impression, or until recently, that everyone thought this crisis was just going to last this winter, and that if we stored enough gas, we would get through, and then by the spring, it would all be over. But the director of research at the IMF just brought out a very gloomy blog. And in that, he said, like, this crisis is going to be the worst since 1970, and next year it's going to be even worse. So I don't know, maybe you could start with Liam, if you unmute your mic. Do you really think this is, are people underestimating how bad this is going to get, or is it going to be worse?
I think it's going to be particularly bad. I think it's going to be very bad across all Eurozone countries. I think what we're seeing is, household real incomes are being squeezed significantly by very high inflation. The energy crisis is just adding to what are already very strong inflationary pressures across the region. When we look at some of the income dynamics across Eastern Europe, for example, some of these countries are going to be facing the biggest squeeze in their income since the inflationary period of the 1990s, and in some Eurozone countries it's going to be for many years. On top of that, we're already seeing evidence right now that Eurozone industry, CE industry, particularly the energy intensive manufacturing sectors, are being hit quite hard. I think it looks increasingly likely that if some of these countries were not already at the start of recession in Q3, they will be heading into one in Q4. The headwinds are just so strong.
Mm-hmm. And Thomas, what do you think? I mean, is this going to be as bad as, what crisis are we going to put this against? 1970, 2008? I mean, where do you think this, where would you pitch the level?
Well, that is very tricky to say. Liam's right that the recession's already here. It's maybe not being confirmed by GDP data because we only get them at the lag, but it's, almost every piece of data you look at that comes by the week just confirms activity is slowing. In terms of magnitude, it's safe to say there's going to be a recession. It's safe to say we're already in a recession. The magnitude is incredibly difficult to gauge because it hinges on so many things. I mean, it basically all goes back to energy and how quickly can the energy prices subside. So what we're forecasting at the moment is for the winter recession, peak to trough falls of about 1% of GDP. That is relatively benign, although still, more severe than what the IMF just put out. I think Liam and Capital Economics expecting something a bit worse. But the worry is that the range here, if things go bad, if say we have a particularly harsh winter, things could get a lot worse.
Because that's the thing that's coming out. It's one of the reasons why I wanted to do this call, because watching yourselves at Oxford and Capital Economics and also IIF, Robin Brooke, he's been very, very pessimistic. He's saying that this is going to be a deep global recession. The IMF, the director of research, was saying that 1 in 3 countries are going to go into recession. And I can't, there seems to be some disagreement as to how bad it's going to get. I mean, Germany's looking at maybe a 2% contraction, which is extremely painful, but it's not that bad. The momentum, I mean, what is driving this? And are we at the very early stages of recession? So we're talking about some discomfort now, but just how far is it going to go? And is it going to hit us this year? Is this going to be the worst part, or is it going to be next year? I don't know, Liam, why don't you take that?
Yeah, I think this is going to be quite a significant recession. You know, Thomas is right. We're expecting a bit of a bigger fall, peak to trough in GDP of around 2% in Germany, 1.5% in some of the Central European economies. You know, we've just published our economic outlook for Q4 today, and you know, we're expecting recessions in pretty much all countries in Eastern Europe and most Eurozone countries. This is going to be very broad. It's going to be here for 3 quarters, perhaps more. You are right. You know, if we do get through this winter, there is a bigger question about what happens next winter. You know, we've had the advantage so far of being able to build up gas stocks ahead of this winter because we've had some Russian supply. What happens next year when we get through, which could be quite a cold winter, gas stocks are very low. We don't have that Russian supply to build gas stocks back up again. So it is a risk as we get through this winter that the crisis isn't over. I think one thing that makes this recession particularly challenging is that there are other headwinds coming along at the same time. You know, we're expecting the US economy to go into recession. You know, there's going to be a weakening in external demand that's going to feed through to exports because of the tightening of monetary policy there. So I think the surge in energy prices is going to be the single biggest factor that causes pain, but there are other headwinds facing some of these countries.
And what about you, Thomas? I mean, do you think that we're at the beginning, or is this going to get worse next year?
Yeah, the old age-old cliche is going to get worse before it gets better. I think Q4 is going to be the first sort of deep cut. I'd imagine Q1 is going to go even. Q1 next year is going to go even worse. Again, Liam's right that there's a sort of multifaceted crisis, and it's also, you know, they're coming thick and fast because we're still living through sort of the aftermath of the COVID crisis. I mean, to what extent is the pandemic actually really over? That, you know, that had big economic ramifications. Consumer spending patterns changed so much. Then it all came back again as lockdown eased. That's still feeding through the economy. That's still responsible for some of the inflationary surge. On top of that, you have the energy prices. And I think, you know, even though there's sort of many factors, I think inflation is still the single biggest drag on the economy, because some of the falls you're seeing in real incomes, so, you know, nominal incomes adjusted for inflation in European countries, that's people being on average 5, 6, 7% poorer. That's a massive drag. Actually, it hasn't been a massive drag so far, partly because people also saved a lot of money during the pandemic when, you know, spending was restricted. But that's, you know, this is not going to last forever. And I think Q4 this year and Q1 next year is when this, you know, house of cards finally comes down.
Right. I mean, let's drill into some of the causes then. I think the one to start with is the energy prices, I mean, which have decoupled, is the word that gets used that often, gone up tenfold. But that's largely being driven by the gas situation. And that ironically, the European storage tanks are now over 90% full, and that they're ahead of schedule in terms of a normal year, and that there isn't a sort of shortage. We've had particularly mild weather here in Europe, which has actually brought some of the prices down. And that's one of my questions, is that we've seen gas prices fall recently, you know, while we have this Indian summer, if you like, or Indian autumn. But nevertheless, they remain high, elevated. And isn't that mostly just sentiment? And with the plans the EU has, aren't those prices going to come down relatively soon? Wouldn't that take one of the factors out of the game? Yeah, I mean, either of you, if you take a pick.
Well, I'll go here. Yeah, yes and no. I mean, yeah, the spot prices have gone down. They remain incredibly volatile, and some new development, either geopolitical or actually economic, in the next few days could swing them right back again. In terms of the way Europe prepared itself for the winter, yeah, there's. I mean, well, maybe I won't go as far as saying there's scope to be optimistic, but when we looked at the storage capacity being refilled quite well at pretty high cost. The supplies that the European countries had to buy, they had to pay a lot for them. But that's sort of one cost to be maybe not optimistic, but it is a good thing to see. Also, there's been in some countries, not all, I'm going to name and shame Italy here, but in many countries, there's been significant demand reduction for gas already. That's already actually more important than anything else, because you can refill the storages this year. Next year, come autumn time, you'll be in the exact same position again. The diversification of supply away from Russia into LNG. That will take time.
That's a key question. I mean, now that Nord Stream 2 has been blown up, the option, I mean, because we had a very fast fill when the filling season began, or whenever that was, about April. But a lot of that was coming from Nord Stream 1, which was working as normal. And now that's out of the game. Is it even possible to refill the tanks next summer for the following winter?
I can take that one. I think you're right. It's going to be a big challenge. And I think that's why, in particular, we're skeptical that prices are going to fall back particularly far in a very short period of time. We think what's more likely is that the European gas market now is going through a very quick restructuring. We're moving away from Russian supply to alternative sources in a very short period of time. It's squeezing European gas markets, and it may take 5 years, maybe longer, for European gas prices to fall back to levels they were at in 2019. I think what we are seeing with the reductions in gas consumption, it doesn't seem to be, at least as far as I can tell, particularly broad energy savings. It seems to be actual demand destruction that's being borne by the industrial sector.
Because Bruegel just brought out a report. They've got this gas tracker. They drilled into the data, and they said that there's been an average reduction of 7% in gas consumption, which is not the 15%, but then we're not at the end of the winter either. So I took that to mean that there's actually been a good, solid response, and that Germany has 11% reduction. Germans have been running public information campaigns telling people to be careful, and Germans are doing what they're told and actually have turned down the thermostat and turning the lights off. But is it even possible to replace the Russian gas? Because, I mean, through Nord Stream 1 was 55 billion cubic meters a year, and I understood that the LNG supplies, such as they are at the moment, cannot replace that much gas, and the alternatives bringing it from Azerbaijan and what have you, are going to add 2-3 BCMs, maybe as much as 10 altogether, some Algeria, but this is a huge hole, this 55 to fill, and that means that next year, well, I don't know, the Germans are also building a couple of LNG terminals, which could possibly come online, big ones too, as soon as next year. But, isn't this just going to be a problem for several years? Because the other alternative is to invest into renewables to replace that energy, but that also will take several years, won't it?
Yeah, that's very true. I mean, I think it's fair to say that come autumn time next year, we won't be, back to 100% when it comes to energy supply, or this sort of back to fully back to replacing what we don't have from Russia. 2 points to sort of make here is, one, there's going to be incredible incentives to do the replacement, either via LNG from wherever, US, wherever we can get it. The other one is Russia will also have to sell its gas somewhere else. Now, obviously, this is not a matter for 1 year, because it takes a while to build a new pipeline, and will take a while to find a new market. I suppose China is the one they'll be looking at, but they will need to sell their gas somewhere else, probably at a discount. Wherever is China buying their gas from right now, might be more keen to buy. It might be more too keen to sell to Europe at a much higher price, because Europe again will be sort of desperate to buy. In terms of renewables, again, absolutely true. This should be a major incentive. I expect the EU will grasp this as a major incentive to bolster investment into renewables, but Yeah, I mean, it's fair to say that next year or next winter, this will still be an issue.
Yeah, the switch to LNG. I mean, before with the Russian pipe gas, which has been coming since the 70s, and the beauty of that was it was reliable because it's on a pipeline. You can't change customers, and so you do these long-term deals. So the price is fixed, and you can plan for that. And LNG was there as a sort of option. Last resort, if the winter was particularly cold and you needed to top up the gas tanks, you could go to LNG, which is much more expensive. And the role of LNG now has been completely changed in so much as it's the main supplier, or one of the main suppliers. I mean, it's been upgraded as a key strategic source of gas. But isn't the problem with LNG is that it's a lot more expensive than pipe gas? I mean, the gas prices used to be $200 per 1,000 cubic, and we've been looking at $2,000 per 1,000 cubic from the LNG. And isn't that going to permanently lift prices for energy in Europe if we're now using LNG as a main source of gas?
Yeah, I think you're absolutely right. LNG is a lot more expensive than pipeline gas, and on top of that, the supply of LNG isn't as reliable as pipeline gas. I think this feeds into this view that this is going to be an energy crisis that Europe has to battle with for quite some time. This winter could be the most painful because this is where the short-term impact of the loss of Russian supply is having the biggest impact. But even into next winter, energy prices are going to stay very high. We think natural gas prices are going to rise again ahead of next winter. They typically rise seasonally anyway. And I think Tomas is right that there is going to be a greater push at the EU level to invest in renewables and alternative energy sources. This might be one of the long-term implications of this crisis, which is much more investment in greener energy, more energy efficient types of energy sources that can come out of this. But this is a 5-10 year problem. It's not going to happen within the next winter or two.
I mean, it's fair to say that we saw the Russian gas or natural gas in general as a sort of transitional source of energy, and then we just got stuck in the transition because it just was very, very easy, and that's now over.
Yes. I talked to the guys at Gazprom Neft, and they were very keen to keep their reliable energy partner status, which they've had since Soviet times. But it seems that the government has made a different decision. But can we sustain this? I mean, if we're talking about high energy prices going forward for several years, not just this winter, then there's talk here in Germany that the economic model has been fundamentally wrecked because it's German industry has been powered with cheap Russian gas, reliable gas, and they use it as an input as well. I mean, it's not actually that important, or it's not super important to electricity generation. But if they've changed it in such a way, I mean, that if you take the German economy out of the equation, or you make it significantly less profitable, isn't that going to have a knock-on effect for the whole of Europe? I mean, for Poland, for Austria, those economies are closely tied to what happens in Germany. And Germany is very exposed to this Russian gas problem.
Yes, this is very true. I mean, the whole European automotive supply chain goes through Eastern Europe mostly and ends in Germany. And if Germany suffers, then this is going to fall back on the other countries as well. This is a very difficult question to answer. I mean, competitiveness, if energy prices indeed remain high, then European industry's competitiveness will come into question. But also, as you mentioned, like not every industrial sector uses gas as an input. Not every industrial sector uses gas as a source of electricity generation. It is definitely a risk. It's just at this point, it's so difficult to tell. But yes, I mean, if Germany is in trouble, then it's not just Germany that's economically in trouble, because a lot of other countries have tied their sort of economic fortunes and their economic growth model to that of Germany being the sort of the final piece of the puzzle.
Because, I mean, what we're talking about here, and what's so mind-boggling about this situation is we're taking the whole of Europe energy infrastructure, where the Russians have pointed their energy, oil, gas, to the West since 1970s, and they're going to transplant that and change it all and point it to the East, which is going to take at least 5 years to happen. But doesn't that fundamentally change the nature of the European economy? If you're ripping out the infrastructure, the pipelines, the power cables, and having to find something else to replace them with something that's less efficient or more expensive and more fickle too, because LNG is a commodity like oil that could change markets or go to Asia if the prices are higher. Whereas the pipelines, those were locked in for 30 years. And doesn't that, to what extent is Europe's prosperity fundamentally threatened by this on a permanent basis, not just talking about, until the war ends and we go back to normal, because there is no going back to normal from this, is there?
Yeah, I think this is a big concern, not just for Germany's economy, but a lot of economies in Europe, that there could be a long-term impact on supply potential and production capacity. It could be some metals mining, metals manufacturing companies that have to close. They go bankrupt this winter and they never reopen. There could be a permanent hit in those most energy intensive sectors.
How important is that? I mean, we've already seen, particularly in Central Europe, all the fertilizer plants, they're basically shutting down because A, they can't afford the energy, and B, they can't afford the gas, so they're getting double whammies. But is that a major economic dislocation for those economies, or is it just like that little bit of the corner of the economy is gone and it's not coming back, but we'll be fine?
I think potentially it could be quite significant. We don't know. I think one of the lessons from the pandemic is that those semiconductor shortages that hit the auto sector are so hard to predict in advance. And it's similar with this energy crisis. We know which sectors are the most vulnerable. We know in which sectors energy costs are a high share of total costs, but there are all these supply chain exposures that we don't know how they're going to work out. There's glass manufacturing that feeds into motor vehicles. There's rubber that feeds into motor vehicles. There's CO2 that feeds into food and beer production, drinks production. There are so many unknowns. I think it's a huge concern that we may see these knock-on impacts on industry as we get through the winter.
Let's talk briefly about the responses. So far, my view on this is like Russia's been putting itself on its economy onto a war footing. Minfin just introduced 10% across the board tax increases. It's hiked the social payments. And they're buckling down for a long fight. And Russia's fiscal fortress that Putin's so busily been building for the last decade has proven to be actually quite resilient, in so much as the Russian economy has done better than expected. Whereas on our side, what I see is that we're just throwing money at the problem at the moment. In so much as when we first started reporting about the aid, it was up to $250 billion, 250 billion. And then there was another round with another couple of hundred, and then Germany just came out with $200 billion in relief and aid, and so I topped the total up to now well over $500 billion. And I think the EU recently said in Brussels that they're looking now at 2 to 4 trillion by next year. And the idea here is to protect the consumers from, that nobody can pay a tenfold increase in their heating bill. It's just not possible. So the governments have to take it on the chin, and they are going to pass significant amounts across. But then this means we're just going to bleed money, and not just for this winter. We're going to bleed money capping these prices for a couple of years. Is that A, the correct response? And B, can we sustain that kind of spending?
Yeah, so on the first one, this is a very, very pertinent point. It's a very good point. So one thing, these headline figures, they're often, say Germany, 200 billion, often a lot of that is not actual spending or spending that's been announced previously. But you're absolutely right in that the fiscal help that the governments are hastily putting through, I'd say we're finally moving in the right direction, both on the EU level, but the national responses are going to be more important. It needs to be sort of very finely balanced, because you want to shield the most vulnerable. You want to protect the households from the massive increases in energy prices, but you also want to reduce the demand, because as you said, if you only cap prices, that does nothing in the long term. So you also want to maintain or preserve the incentives, because energy costs are high, to consume less energy. So it seems that the ideal mix is some sort of an intervention in the wholesale energy market, because those are the ones who have been sort of benefiting from the situation, perhaps less than many people imagine due to various intricacies of the wholesale market, selling ahead and then hedging and that sort of thing. And then there will have to be some transfers, direct transfers to not just low-income households. I mean, people sort of underestimate that even what tends to be described as sort of middle-income households, with energy prices not being mitigated in any way, they still struggle. But I'm taking some comfort in that European governments, again, both nationally and on the EU level, are heading in the right direction. In the traditional EU fashion, it took a while, but it seems to be at least on track now. But still, the more details are still sort of scant.
Can we, I mean, the EU as a whole has significant borrowing power, and moreover, during the pandemic, for the first time, they experimented with a pan-EU bond. So there is an option, because at the moment, all the spending is being done at a national level, and the Germans got criticized because they basically offered too much, and the other countries were saying, look, this is a subsidy to German business because effectively they can have cheaper power than us, and therefore they're going to become more competitive. Ironically, that was an argument that used to be used by the States against Russia. So I'm kind of amused to see that one come up. But as I say, it's at a national level. But can we afford, a simple question, I mean, can we afford to spend $2 to $4 trillion a year on subsidizing energy in our markets for a couple of years? Do we have that much borrowing power? What's it going to do to national budgets? Isn't this going to cause a debt crisis in the end?
It's a good thing to be concerned about. Good question. Sorry. I think the sums we're talking about at the moment, on average around 3 to 5% of GDP this winter. It's a significant amount of fiscal support. Insofar as that stops economies from going into a deeper recession, it stops a bigger fall in tax revenues, then it will have some impact on the budget, some offsetting impact on the budget. I think the long-term fiscal impact of this crisis, of course, I think depends on how long this energy crisis goes on for. But also one point to bear in mind is that high inflation can help or can allow countries to run a larger budget deficit and keep their debt ratio stable in the long run. It depends how high inflation is and how that boosts nominal GDP relative to interest burden. But potentially over a longer period of time, if the energy crisis is not as bad in the future as it is this year, then I think potentially we could see those budget deficits remaining quite large over a period of time.
Yeah, I want to get on to inflation in a minute. There was one more question I had about the relief support packages coming in. I forget who it was. I think it might have been Bruegel, but they pointed out the trouble with capping the prices and not passing that pain to consumers is there's no incentive to reduce your gas consumption. And so actually you're spending a huge amount of money to make the crisis worse, or at least to extend it, because you need people to actively reduce their consumption. And the example that was given was Italy, in so much as I think Italy's made no reductions at all to its gas consumption, or maybe slightly 2%. And if you look at Spain and Portugal, they've actually increased their gas consumption, but then they're not affected because they've been importing LNG on long-term contracts, so they're not having the same crisis as everyone else. But isn't that misguided? I mean, don't you need to inflict some pain on the consumer and industry in order to force them to reduce their consumption?
Yes, that's a short answer. Yes, you do. And that's why the design of the fiscal support package is really important. For example, Germany, did try to tap what I would call sort of a team of economists to design the package. But I mean, yeah, the idea is to preserve incentives to reduce energy usage while still shielding, because there's, you can't pass through all of the pain to consumers. That's too much. You need to sort of calibrate it so you have just enough reduction of demand, so it doesn't come to sort of what we call hard rationing, just basically a blackout in supply of energy. But at the same time, there needs to be sort of a balance.
Are blackouts off the cards? Because the Ministry of Energy in the UK just warned people that there could be blackouts. And the prices in the UK for power are particularly high. But I was under the impression that with the 90% full tanks now, that we're probably going to avoid that unless there's a very cold winter.
Well, as far as I know, UK has essentially no gas storage capacity.
Yes.
Because it got rid of it.
Yes.
So I'm not an energy expert, so I couldn't tell you whether blackouts are likely or completely off the cards. But also, yes, I mean, gas is, the sort of center point of this crisis, but there's been also other issues in other electricity generating bits of the market. And this is something also where we sort of expect an improvement. One is hydropower, which has struggled a lot over the summer with basically dropped. That should hopefully, if weather returns to normal, that should not be a problem over winter. The other one is the French nuclear fleet, which also struggled, as far as I understand, due to cooling problems. Again, low levels of water in rivers. Again, that hopefully will gradually ease, as it is already easing. So that's sort of, I suppose this is the best optimistic take I can offer. But there's, some bits are also improving.
There's been almost a perfect storm because, I mean, on the one hand, we've had the problem with the Russians, and that's all been driven by politics, geopolitics. But then we just happened to have a blazing hot summer, which reduced the reservoirs, particularly in Scandinavia. And at the same time, the French just happened to have a nuclear power maintenance problem that took whatever it was, nearly 40% of their capacity out of action. So this all came together at once, but I guess we should be on an optimistic note so that everyone's sort of rallied around and cope relatively well.
I think we also now deserve a very warm winter in return.
Well, is there any view on that? Because I saw the FT published a piece saying that, they had some meteorologists who said that actually this is going to be a very cold winter, but I don't know, we can't know, can we? No one has a sort of a view, a comprehensive or authoritative view on that. So moving on to inflation, this is the other problem that's going on, and actually was there beforehand, before this whole Ukraine story broke out. And I saw some figures from Eurostat that the 70% of inflation at the moment is being driven by a combination of food prices and energy prices, and that's despite the fact that those two things only make up about 30% of the basket. And then Liam, Capital Economics just brought out this enormous report, which I'm wading through, about the fracturing of the global economy. But within that, there's the point that we've had like a decade of very low inflation, and that's been driven by huge productivity gains. And at the same time, the opening up of, or the end of the socialist experiment. And that led to globalization, which dropped costs and kept inflation down. Plus, you've got migration of cheap labor. But what's going on at the moment is now the system's breaking up, and thanks to COVID, the supply chains are getting shorter. The globalization is sort of coming to an end or petering out. That not only is that driven inflation higher, but that it's also going to be a lot more sticky. It's going to be a lot more difficult to get rid of. And the final point with inflation is that the inflation has been driven not by normal things like changes in demand and money supply. It's been driven by things like disrupted supply chains, and central banks have no control over that. Hiking the rates doesn't make any difference to your supply chain. So aren't we stuck with this very nasty problem that's just going to make everything worse? And there's another one that's not going to go away for several years. Liam, maybe you can take that one.
Yeah, I think the short-term inflation outlook across Europe is particularly bad. We're significant upward pressure on inflation, like you say, from food prices, energy prices. What we're seeing in some parts of Central and Eastern Europe is some of those second-round inflation effects are looking a bit stronger now. Particularly when you combine this with the strength of demand in some of these countries, the very tight labor markets. Food inflation in Hungary, for example, is way, way stronger than it should be based on the indicators of food prices we've looked at. And I think a lot of that can be pinned down on some of these second round effects. And at the same time, all of these European economies are dealing with currency depreciation because of the strength of the dollar and how that's feeding through into import prices. The way we're looking at the inflation outlook over the next year or two is that some of those supply chain disruptions that have pushed inflation up at the start of 2021 and early this year should fade, particularly if we have weaker demand in advanced economies. but they may be taken over by some of these other forces. And we think it would probably take quite a deep recession to cause a marked weakening of labour markets, to bring down wage growth, and then bring down some of the core inflation metrics across Europe.
Isn't that the plan, though? I mean, given that hiking rates actually has no effect on inflation, in the traditional sense, but you slow the economy, and that will bring inflation down by causing demand destruction. But that's like, hitting the problem on the head with a hammer. And you're just doing as much damage with the hammer as you are doing as a cure. I mean, isn't that a sort of, the wrong way round?
But that's also the challenge when inflation gets to such extreme levels. It takes a significant monetary policy response to then weaken demand and bring inflation back down. And the difficulty now is that when inflation gets to these types of levels, supply shocks, price shocks, like we're seeing with energy at the moment, can sustain inflation above central bank targets for quite a while. I think inflation will come back down to central banks' targets. It's going to come with a cost, and it might take a few years.
I mean, you're following Central Europe quite closely, and we've been writing about there was a huge row in the Polish central bank where they're threatening to take each other to court over the differences, but the politics is coming into that now as well. And so much as the three members that are linked to the opposition are blaming the government and saying they just it's not a problem. You've just got this wrong, and then the economists are saying no, it's supply chains and all the things we've just mentioned. But is there any sign of, Poland, I think, is at 25-year highs? Is there any sign of it peaking out, and then these big rate hikes that they've been pushing through are actually starting to have an effect?
It's a good question. I think I've been quite critical of the Polish central bank this year because they were quite slow to acknowledge the extent of the inflation problem. It's almost as if for most of last year and early this year they had their head in the sand, and I can see why they've had a lot of criticism from some ex-MPC members and colleagues. The impact of monetary tightening is feeding through quite slowly. It's not as strong right now. I think it will get a little bit stronger. When I look at the breakdown of core inflation, it had looked like some of these domestically driven price pressures were starting to fade over the summer, but then in September, inflation shot up again, and then you sort of scrunched up that piece of paper and chucked it in the bin, and we went over again. It looks incredibly likely that inflation is going to continue rising because of the energy prices, because of these core inflation
but it's already
pressures.
at insane levels. I mean, they've got inflation over 20%, and what's the overnight rate now? Something on the order of 6 or 7?
6.75% in Poland, with an inflation rate that is going to reach 20% in the new year. It's a significant inflationary imbalance. One place where we can see inflation start to slow is in the Czech Republic. I think it's benefiting a little bit more from the fact that its currency hasn't fallen as much as the other countries in the region.
Yeah, and that was one of the central banks that went all in very early. It was, at some point leading, or sort of maybe with Latin America as well, very sort of front-loaded hiking rate, which maybe now is paying off. Because if you look at as Liam was saying, if you look at the breakdown of inflation in Czech Republic, right now all the increases are pretty much driven by food and energy prices. So as you mentioned, something that's very much at the mercy of global markets, very much outside of control of central bankers. But core inflation, that's sort of the measure of the domestic pressures in the economy when it comes to prices, is now actually falling. So yeah, there are economies that, who responded early. They're already seeing tentative signs of maybe inflation peaking or core inflation peaking. But as Liam mentioned, it's very true. It's almost like whack-a-mole game in the sense that when you think the inflation is already peaking and you publish a report saying yes, inflation is peaking, suddenly there's another 5% monthly increase out of nowhere. So it's been very, very persistent.
Isn't it true, you guys as economists, this has been one of the most exciting, or at least unpredictable periods of European economic history there's been for decades, isn't it? I mean, because there's several times he was saying we don't know, we can't say, it's going too fast, I mean, it's too extreme.
Yeah, I mean, a personal anecdote is I joined Oxford Economics in 2019, September 2019, where we spent our months debating whether the German industrial production forecast should be 0.1% higher or lower. And then came February 2020 and the pandemic, and it's been a bit of a roller coaster since. Yeah, it's true. It's a lot of these things, because often, as economists, we look at correlations in past data. We estimate our models, however sophisticated they are, on past data. These things don't necessarily feature in past data, so it is incredibly tricky. And it's also, I think, led to some very interesting developments in sort of in terms of what data we look at. Very high frequency, very granular. So we're trying our best, but yeah, it has been very tricky.
Well, talking about that, I mean, the point with like Liam was pointing out, there's a huge gap between the prime overnight rates from the central bank and the rate of inflation, over 10%, 12, 13%, which means you're running in effect a huge negative real interest rate. And given that a large part of that inflation is outside of the central bank's control, supply chains, energy prices, does that mean that that's justified to have these huge negative interest rates? Because what you're doing is you're setting the rate for the bit of the whole system that you control, the demand and monetary supply. So that's okay to have that massive gap. Or, in my layman's terms, you just should be hiking the overnight rate to the point where it matches or is greater than inflation. That's normally the case, isn't it? Liam?
Yeah, I think interest rates in Central Europe probably should be a little bit higher than they are. I think I've certainly been surprised that central banks have brought their tightening cycles, are very close to bringing their tightening cycles to an end at a time when inflation is still rising quite sharply, and on a monthly basis doesn't seem to be turning at the moment. I think probably would be unreasonable to expect some of these central banks to raise their interest rates in line with inflation. A 20% interest rate in Poland would cause so much harm. It would it'd be quite devastating. But I think at least with these currencies coming under so much pressure and the inflationary impulse from that, I think there's a case that central banks are going to find it difficult to maintain interest rates at their current levels over the coming months, particularly heading into winter. I wouldn't be surprised if Hungary or Romania, for example, if they're forced to raise interest rates a little bit more, just because some of these inflationary pressures turn out to be a bit stronger than they thought they would be.
Is that a political thing? Because if you raise the rates too much, I mean, the IMF were making this point in the blog, and there was, you don't want to raise them too high because then you'll cause a recession. But if you don't raise them high enough, then you get runaway inflation. It becomes more expensive and painful to get that under control later. And actually, they were suggesting this path between those two courses is actually very narrow, and it's very difficult to guess where it is. But there's a political motivation here too, because you don't want to raise them because that brings the government under pressure. And you can point to the US where they've been hiking rates quite fast, and suddenly the housing market has collapsed. Nobody's taking out mortgages anymore because it's starting to get really expensive. And the knock-on, if you have floating rate mortgage and you hike the rates really sharply like Russia did, or Ukraine 20-25%, then that causes chaos as well. And then you get social problems, you get social unrest and protests. So I mean, to what extent is that, how close do you think they are to that golden mean between these two extremes? And is it a political problem? I mean, is that what's holding them back?
Yeah, it's very difficult times to be a central banker in Central Europe and in the ECB, Bank of England, the Fed as well. I think for the advanced economy central banks, there's definitely been that sort of desire to make up for the slow start with really large hikes, 75 basis point hikes we've almost never seen before, very rarely. It's tricky because, in ideal world, from the sort of optimal control perspective, you would be raising the rates gradually until you reach what's sort of known as the terminal or the neutral rate, at which the bank would stop, and eventually things would sort of fall into place. What's happening right now is pretty much every single central bank will go way over the estimate they have of the neutral rate or the terminal rate they should be keeping in the long term, and then they'll have to cut back to it. Whether it's political, I don't know. I mean, for most central banks, their target or the mandate is very simple: keep inflation stable around 2 or 3%, whatever it is. But the things you need to take into consideration for that enormous. It's not just current inflation, it's inflation expectations, it's the projection that your staff is making for output. A lot of these central banks are now forecasting recessions in their economies. I think some of them are hoping that that's going to do, say in Eurozone, I don't think you can really, if there's the recession, which we all think it is already happening, you can't really pin the blame for that on the ECB, but I'm sure the ECB is hoping that that's going to do some of the heavy lifting in terms of reducing inflation for them.
Right. Yeah. To what was I going to ask? To what extent stagflation? I mean, this was brought up relatively early on this year. To what extent are we headed for that, though? I mean, we have high inflation and we have recession. But that can be a very nasty problem. I was a kid when we had it in the UK in the 70s, but I remember it. It was probably the first economic term I ever sort of was conscious of was stagflation, because it was talked about and everyone was complaining, saying how painful it was. Is that realistic? Is that something that's on the cards? And aren't we already there to some extent?
I think stagflation, it was talked about a lot in advanced economies last year, just as we got the taste for it. And it doesn't seem to be talked about as much at the moment, although it does seem to be a lot more appropriate right now. I think in Central and Eastern Europe, I don't think it applies to the same extent as maybe in advanced economies. I think Central European economies are faster growing. They can sustain a higher rate of growth over a longer period of time than advanced economies, and I think the inflation shock we're seeing will end up being temporary. So I think this could be stagflation-like conditions for a few years. But I think with the way central banks have responded, I think the way that global currency markets should adjust into next year in 2024, I think we should be returning by the middle of this decade towards more normal conditions. But it is going to be a painful 2 or 3 years.
So I know not that much about it, but I was reading that the central banks are much better equipped than they were in the 70s, and that they have more financial firepower, that they can deal with this problem of stagflation, whereas before they didn't know what to do. And now it's like been done before, and you've got to bite the bullet and hike rates. And as you say, everybody has hiked rates quite aggressively. But funny enough, the very first central bank to end its easing policy was the MBU in Ukraine. They made the first hikes, followed shortly by the Russians. But then in Russia, the inflation is falling. But I don't know if we can actually read anything into Russian macroeconomic numbers, if they mean anything now. But it's been steadily falling since April. It's the only country in Europe, I think, that has falling inflation and has been cutting rates already. Do you think that's, we can read anything into that? Or is that just like, it's all a bit, well, because the economy is so hermetically sealed off from everything now that it doesn't really mean anything what the central bank does now?
Yeah, again, not an expert in Russian economy, but I'd lean towards that explanation. The economy Russia's running now is very, very different in all ways, shapes and forms, because of the sanctions, because of the lack of access to global financial markets, because effectively turning onto, it's not a planned economy as such, but the war efforts turning into something like that. So the sort of standard, price being an economic signal point of view, I don't think it applies that much in Russia at the moment.
So the last question I have is, to what extent, it seems to me that it's the countries on the eastern side of Europe are the ones that are most exposed to all of this, and they're the ones that are also the most dependent on the Russian energy. And if you go further west, then the problems seem to be less. I mean, so we look at the EU as a whole. However, which countries in the EU and Central Europe are the most in danger or the most exposed? I mean, we've talked a little bit about Germany, we've mentioned Italy. They seem to be in the front line because of their energy dependence. But looking at the other economies, I mean, some of them, like Slovenia, is doing relatively well, I think. I mean, isn't there a big difference between the members of the EU as to the problems they're facing here?
I think without a doubt, the Central European economies, the likes of Czech Republic, Slovakia, Hungary, are by far the most exposed to the energy crisis as we head into winter, not just through the price impacts, but also through the threat of rationing. I think the Czech Prime Minister summarized this in a recent speech a few months ago, where he said the Czech Republic is a landlocked country with no offshore wind, no no good sense of energy security. It has to import. It has that vulnerability that makes it particularly exposed to what happens with Russian gas. I think if we were to be talking about a gas shortage / energy rationing scenario as we head into the winter, very easily we could be seeing double-digit falls in industrial production in some of those Central European economies, big falls in GDP that just compound the long-term impacts of this crisis. Hungary's a bit of a tricky one in this because of the relationship that Hungary's government has with Russia and the way it's secured special gas supply deals. But I think particularly Czech Republic and Slovakia, we should be most concerned about.
Yeah, I can only agree with that.
And is this going to not lead to some sort of debt crisis or financial crisis? Because again, the read across from the 70s is that what the stagflation that was with when the rates were hiked and the damage that did, that destabilized the markets. And we had a series of financial crises. So the whole thing became a lot more top heavy. And is it possible to have the same this time around?
I don't think that's too likely, but the thing with financial crises is that the last one's the next one's very different to the last one. There is some concern now with rising rates and sort of what the UK has shown us over the last 2 or 3 weeks since the mini budget, that things can get quite ugly quite quickly. And UK is an advanced economy with a very respected central bank and sort of almost used to be a paragon of stability. Some of these Central and Eastern European countries don't necessarily have that. There's now, you mentioned housing markets in the US. It's not just the US. There's, Czech Republic is actually a prime candidate for that with its housing market. So that's something to watch. I think, or I'd like to think or like to hope that we've learned lessons when it comes to these, massive rate hikes, what the implications, the fallout for the economy can be. I think the macroprudential policies have been developed a lot more than 40 years ago. But so I think, like full-blown 80s, 90s style financial crises, hopefully not as likely. But yeah, I mean, these are exceptional times. So it's really hard to tell. It's really hard to say something's not on the cards.
Yeah. So Liam, I mean, we're about to run out of time. I mean, how would you summarize? I mean, what's your outlook, your take? I mean, where are we headed? What's your prognosis? Are we doing the right things?
It's going to be a challenging winter for Eastern Europe and many Eurozone countries. I think the base case is that there will be recessions. I think what's uncertain now is how long those recessions last and how deep they're going to be, and how that spills over into labour markets. I think it's possible that we manage through this winter without rationing. Obviously, a lot needs to go our way. We don't want a cold winter. We want to be able to continue importing LNG from abroad. We need a few things to go our way. But provided that does happen, I think we could get through this winter with only a small recession. Bigger questions there, though, on what happens next winter and some of those long-term implications of this energy crisis and how Europe adapts to this new world remain to be answered.
Thomas, do you have anything to add?
Yeah, maybe just on the sort of longer term implications, when I say longer term beyond this winter. I mean, yes, there's, lots of infrastructure needs to be built, lots of investment needs to be made, both on, substituting from Russian gas to maybe LNG and renewables. But, the price or the reward for doing this is great. And the incentives to do it are also very high. And I like to think maybe, during the COVID pandemic, how this is maybe not the best metaphor of comparison, but how quickly we managed to develop the vaccine when so much hinged on it. I think once the wheels start moving, once the policymakers and firms realize how much hinges on doing this quickly and doing this properly, we could actually be potentially surprised that we could pull through it maybe better than we think.
Well, yeah, to be optimistic, there's an opportunity here if we're going to borrow and spend all that money to finish the green revolution, which would give us, in theory, reliable, cheap energy forever, which would be a huge plus. But then again, I shouldn't be pessimistic, but this whole discussion has assumed that we don't go to war with Russia and they don't drop a nuclear bomb on us. And so the trouble with Russia has become so unpredictable that, we've both been saying shocks and surprises all the way down the road. And I don't actually think, or rather it would be prudent to assume that there's going to be some more of those going ahead. But on that slightly confused note, I would like to thank you both, Liam and Thomas, for joining me. Fascinating discussion. I think we cleared up a lot and made it much clearer what the problems are, what the issues are going forward. And I'd like to thank everyone out there in internet land for listening. We do these regularly. That you can find a recording of this podcast on our YouTube channel. And if you're interested in knowing more about BNE, we cover this patch daily, covering business, economics, finance, and politics. If you head over to, you can see on the screen now, IntelliNews.com/welcome. There you can sign up for the editor's picks, which is our free daily email, digest of our best stories from the last 24 hours. You can also, if you're in the game and want to know a lot more, then you can sign up for a 2-week trial to our premium service Pro. And the links for our YouTube channel there are there as well. So once again, until next time, thanks again to both my guests, and see you next time. Ciao.